All right, today we're peeling back the layers on Artner Corporation's latest financial report. And let me tell you, this is way more than just an explainer on numbers. This is about decoding a story of a huge strategic shift and some serious future ambition, all tucked away inside their Q3 results.
So think about it. How does a company really show you it's about to make a massive change? It's usually not some big, flashy announcement. It's often something much more fundamental.
And boom, that is exactly what Artner just did. By changing the very way they count their money and measure their success, they're sending a crystal clear signal to all of us that we need to look at them in a totally new light. Okay, so let's dig into this first big change because honestly, it's the key that unlocks everything else in this report. For the first time ever, Artner is using what's called consolidated accounting. So what does that actually mean? Well, in simple terms, it means we're finally getting to see the combined power of Artner and all its smaller companies, all reported as one big, unified team. This is literally our first glimpse of the whole machine working together. And that's exactly why you won't see them comparing these numbers to last year. They've basically hit the reset button. They're telling the world, forget the old way of looking at us. This is day one. This is the new starting line. So now that they've drawn this new line in the sand, how'd they do? Does the performance actually back up the bold move? Well, let's dive into the financial proof.
First up, total sales. In just the first 9 months, this new consolidated Artner Group pulled in 8.9 billion yen. That is a seriously strong top-line number to kick things off.
But sales are just one piece of the puzzle. What did they do with that money? Well, they turned it into nearly 1.5 billion yen in operating profit. And that tells you their core business isn't just selling a lot, it's running incredibly well. And the bottom line, what was actually left in the bank? Over 1 billion yen in net income. That is just undeniable proof of a super healthy, profitable company right from the start of this new chapter. Now, this is where you can really see their momentum. Take a look. With a whole quarter still left in the year, they're already at about 80% of their annual profit goals. I mean, they're not just on track, they're absolutely cruising toward an amazing year-end. And holding all of this up is a financial foundation that's, well, rock solid. Their equity ratio is 68.6%. What that means in plain English is that the company owns almost 70% of itself. It's not loaded up with debt. And why does that matter so much? Because it gives them a ton of flexibility and cash to make big, bold moves without a lot of risk. So the results are obviously fantastic. But where is all this performance actually coming from? Let's pop the hood and take a look at the engines that are really driving Artner forward. Artner's success really boils down to two main things. First, you've got their bread and butter business, what they're famous for, dispatching skilled engineers to clients. But then you've got their big strategic growth area, the outsourcing business, where they don't just supply the engineers, they manage the entire project. And you can see their strategy paying off in a big way right here. That outsourcing business is now 12.5% of their total sales. That's not a little side project anymore. It's a huge part of what's driving the company's revenue. And look, this isn't happening by chance. They're riding a massive wave of demand in Japan's economy. We're talking huge needs from the auto industry and an absolutely booming semiconductor sector. This lets them charge more for their talent and even get new graduates placed faster than they planned. It's the definition of being in the right place at the right time. So what do you do when you're making good money and you've got that super strong low-debt balance sheet we talked about? Well, you don't just let that cash sit there. You put it to work. You invest in even more growth. And this is where the plot really thickens. Because the biggest news of all wasn't actually buried in the financial report. Nope, it was a separate announcement they made on the very same day, December 8th, that really shows you where their head is at. They announced they're buying a company called Joho Jiken Incorporated. Now, these guys are specialists in R&D support for the auto and aerospace industries. This isn't just a random purchase, it's a surgical strike, aimed right at the heart of two of the hottest tech sectors around. And get this isn't a one-off. It comes right after they bought another company, Clipsoft, earlier in the year. A very clear pattern is starting to emerge here. Artner is on a strategic shopping spree, buying up companies to get new high-tech skills. And the crazy part is, they're not making this up as they go along. This is them literally just following their own playbook.
Their public midterm plan flat out says they want to evolve into a comprehensive technology services company through M&A. They told us what they were going to do, and now they're doing it.
Which brings us right to our final fascinating question. When you've got a fresh start, a clear strategy for buying companies, and a balance sheet that's like a fortress, you're really just getting warmed up. The real question isn't if Artner will grow, it's which high-tech sector they're going to target next.